Assets-based valuation starts with all resources or assets that you have and liabilities on the other hand. Difference between assets and liabilities is a net asset value or your equity value. This type of valuation starts by looking at your books, but the book values should be adjusted to market values for all individual items in order to get the real value. For example, you bought some assets, for example equipment, 5 years ago, started depreciation and have some remaining book value. Over the years, you have used the assets more or less. Market prices have changed, maybe that equipment became obsolete due to technology improvements and similar. So you have to find out what is the current market value for this type of asset. And you should do that item by item. Usually this is done by auditors in general, but they use valuation reports from specialists for some specific items like land, buildings, equipment and similar. For other items, they usually do it by themselves. For example, they are looking for inventories, when they are bought, their condition, their expiration dates and similar. Receivables. Are there any customers that haven't paid you in some reasonable time period? Are they in struggle and similar? Are there any transactions with your related parties and what are the conditions? They are looking for potential litigations in consultation with lawyers, etc. In case of liquidation costs should be added in calculation. As you can see, auditors will make the adjustments and get net asset value or adjusted equity value. One of the key arguments for using this methodology is the fact that potential buyer is purchasing a set of assets, not some sort of guaranteed future cash flows. Simply, no one can say what will happen with the company in the future. If the company is run properly, this is the lowest possible value or bottom line, because that is the amount that will be needed to replace all the items needed to run a company.